Welcome to Barchart's weekly series of webinars to help you, the investor and trader, to navigate Barchart's pages, tools, and the trading ideals and strategies that they support. Today's subject, bear call credit spreads. This commonly used option strategy allows bearish traders to profit from the price of an underlying asset falling with limited risk and not having the logistics of shorting the stock. Welcome, everyone. Hello. My name is John Rowland, and hopefully by the end of today's session, you'll have a better understanding of credit spreads and their philosophies, risk, and the mechanics to allow you to construct a profitable trade. As always, with me today is our moderator, Jean Baker. Hello, Jean.
Hi, John. Hello, everybody out there.
Let's give a shout out to a couple of our regulars. I see Orlando's in the house, so hello, Orlando. So, Gene, I need your help today because, I've told you before that my nickname on the floor of the exchange was Bull because I was always bullish. So I need you to, I guarantee you that at some point today that I'm going to substitute or switch bull for bear, just because that's the way I am. That's my DNA. So you need to keep me on top of my toes. So if I accidentally say a bull put credit spread, you know that I'm really talking about the bear puts. So I just want to ask you to do that for me today.
I will keep on you on that. All right, John?
Okay, good. All right, I want to remind everybody that all of our webinars are recorded and that you can find those recordings inside of the tools of free webinars page, and here's the archive of all those webinars. And the reason why I say this is that some of the criticism I always get is that I go a little bit quick, or that I develop an idea that might be a little bit advanced or over some people's heads, and they don't get a time to digest that in the live session. So, I employ upon you that, here you can come back and listen to those recordings and digest that material at your own pace. Okay. All right. Also remember that today's session is an educational purposes only, and that the decision to buy, sell, or hold any security, commodity, or investment involves risk and best made based on the advice of a qualified financial advisor. I'm not here to endorse or be construed as an endorsement or suggestion of any kind of buying or selling any stocks or those strategies, and that you need to be aware of those elements, and that things that have worked in the past or strategies that have worked in the past, especially those that I'm going to bring forth from my own personal experience, are not necessarily or indicate of future results. Okay. All right, so before we jump into the deep end, let's get a little groundwork in so we're all on the same page here. And what is the definitions of a bear call credit spread? And so a bear call spread is a limited risk, limited reward strategy where is sell one call, which we're going to call leg one, and we're going to purchase another call. We're going to call that leg two. Now, the strategy itself is best designed for traders who have a bearish outlook and that they believe that the stock or the underlying asset is going to decline in price or maybe just hold steady. The first leg is going to be sold at a price that's closer to current price, and the second leg is going to be purchased or long at a higher strike. And this result is going to create a credit for us. That's why it's called a credit spread. Now, our maximum profit is limited to the original net credit that we receive, the difference between how much we take in and how much we have to put out. And our maximum risk is limited to the difference between the two strike prices. We're going to call that strike differential, and the net credit that we receive. Notice that our maximum profit is only achieved if price is below our lower strike expiration. Okay, break even occurs if the strike price is above our lower strike, our call, our leg one, by the amount of the credit that we take in. So here's an example, a chart, because I know you guys like visuals. So what's our maximum profit? Well, here you see in this example, we're looking at Exxon. We're going to short the $42 call, and we're going to receive a credit of $2. At the same time, we're going to purchase the $47 call, and that's going to cost us 50 cents. So we're going to take in $2, and we're going to put out 50 cents, and we're going to have a net credit of $1.50. Now, we will only achieve that maximum profit, that $1.50, as long as the price of Exxon stays below $42 at the time of expiration. Now, what's our maximum loss? Well, our maximum loss is going to be the difference between our two strikes, in this case, $42 and $47. That's $5 minus the credit that we're going to take in, the $1.50. So the maximum we could lose on this trade is $3.50. And what would happen is if price of Exxon got above $47, we would be assigned or called on our $42 strike. We would exercise or call in the $47 strike. And so we would just be the net difference between those two minus the credit. Now, our break even is based on the credit that we take in plus that lower strike. So lower strike here is $42. We're going to take in $1.50 a credit, and so our break even is $43.50. Now, we're going to talk about the philosophy of trades in a second here, but there is a scenario where I could still create profit where the price of the stock does not go below my lower strike. In that scenario, what would happen, let's say that the price of the stock is somewhere between that lower strike and my break-even point at the time of expiration. Now, what could have happened is that the premium that I took in before expiration could be greater than the intrinsic value of the call that we sold. For instance, let's say on the day of expiration, Exxon is trading $42.50. There'll be no premium in this value, but it would be an intrinsic value of 50 cents. My net credit in that case was $1.50. So I could conceivably make about $1 on that trade. Now we'll look at some risks that are involved with that, but I just want to show you that there is some opportunities still to have a profit, even though price does not go below our strike price, our lower strike price. So here's this philosophy of the trade, that those traders who have a more bearish or mildly bearish outlook will achieve much greater profits if they take a short call strike that is slightly in the money. In other words, the strike price is going to actually be below the current price value. And that maximum profit will only occur if price does fall below that strike price. Now, this does create a greater risk for our traders. Now, the risk is in a monetary value because our risk is going to be limited by our strike differentials. That risk is in something that's called early assessment. Those traders who take our short, buy from us, that call, they might call us, assign us, and then we would have to take delivery of that stock. In other words, we would have to buy that stock. So there is something called assessment risk that we need to be aware of. The other philosophy of credit spread traders is those who are slightly bearish or believe that stock price is range bound. It's stuck in a range, and that when they execute this trade, they're looking to sell credit when price is at the higher end of the range in anticipation that price is going to stay in that range or maybe deviate or meander back towards some mean value or somewhere in between, right? And so those would be better by choosing that first leg that is just a little bit at the money, and we'll make the distinction of what that means, or slightly out of the money, about approximately about 5% from current value. All right, and this is a much more conservative strategy. It results in smaller profits, but in this one, we don't need the price of stock to go down. We can actually still gain our maximum profit just as long as price stays where it is, or if price kind of drifts sideways or a little bit lower. So there's two philosophies here of this strategy, and I'm going to advocate for those of you who are new to options that we're going to look at, and what we're going to discuss today is the more conservative approach. All right. Hey, something called time decay, theta. We don't really talk about Greeks in our recent options seminars, but what theta is a term that says how much that premium that's inside of our option that we sell is going to devalue or decay as we get closer to our expiration. And so this devaluation or this decay in our options is not linear, it's exponential, and it actually increases as we get closer and closer to expiration. So you here see the definition that is defined by Investopia. I did it right. Okay. So time passage is to our advantage. That's what we want. We want time to go. So every day that price stays below our lower strike, we are actually starting to collect more and more of that net credit or that maximum profit. Theta theory says that inside of 30 days, the decay starts to increase. And not only does it increase, but it increases exponentially. And so what we want to try to achieve then is when we set up these trades, these credit trades, we want to look for trades who have shorter days to expirations. We're going to defer to that when we look at our filter as the DTE, days to expiration. So we're going to look for shorter time values closer to expirations. When we talk about debit spreads, where we're putting money out, right, we talked about looking for longer periods of time. Here, we're going to look for shorter periods of time. Okay, so there are some additional risks that I just mentioned to you that it was important for you to understand, and let's look at those. So first, this concept of early assessment. Assignment. This could happen at any time, right? But it generally only occurs when the price of the stock starts to rise at our lower strike or gets above our lower strike, where the purchaser of our put has made a profit or can make a profit by exercising that not put, that call. See, I told you, Gene, I was going to do it. Purchase that call. So
yeah, you caught yourself though, John.
So that is where we might see early assessment, okay, or assignments. So also, I want you to be aware of that a stock could do something crazy or have be involved in, let's say, a restructuring or a news event based on a merger or a takeover or a spin-off or a special dividend, or even an earnings report will disrupt the normal process of this decay and these credit spreads. So I do know there's a lot of credit spread traders who do take on earnings reports in anticipation of, maybe a positive earning report or a bearish earnings report. And I give those credit traders a lot more credit. That's a little bit outside of my pay league or pay scale. All right. Expiration risk occurs when on the day of expiration, if the stock price is close to that first leg, if it's at or slightly in the money, right, that intrinsic value, then the trader might be assigned that call and be established a long position. In other words, you might have to buy that stock to cover that position that you've been assigned. And so in order to buy to cover that anticipated short position, okay? And since assignment isn't known until the following Monday after the expiration, the trader would be at risk to this new established long position. If you didn't get assigned, right, then you would have that position. So our best practice is when we get to expiration and we are coming to expiration, if I'm at that scenario where I'm close to that lower strike price, my current price, then my best practice is to close out the whole options position, right? So we're just going to close that out. But as long as I close out my position, if I'm going to be get an assignment, you'll get a notification during that business day. And if I don't want assignment, right, let's say this is not on expiration day, then as long as I close out that position before the end of the day of that notification of assignment, then I won't be assigned. So I can get out of this trade to that effect. Now, the other scenario that I also talk about is something called the Steve Miller scenario. And the Steve Miller scenario is, let's say we put a trade on, and within a couple days, the trade goes our way. We get a big sharp price movement, and the trade goes my way. Well, I'm going to Steve Miller it. In other words, I'm going to take the money and run. If I can get 80% of my total max profits on a quick price movement on one of these credit spreads that I put on right away, then again, I'm going to probably just unwind that trade and close that trade out. All right, so here we are in options. We're under the bear call credit spread. And our screener is going to screen all the stocks that are out there to give us, break these down and see what there's out here. Now notice that the result is 2030. So that's a lot of stocks to dig through. So there's a couple things we can do to make some adjustments. And I'm going to show you a filter that I've created myself. But let's talk about a couple things. First of all, notice how it's the symbols here are random, but it categorized them in terms of max profit percentage. So that's how it's ranked. So if you know, for instance, a particular stock that you're looking at or a symbol that you're looking at, you could go into your set filters, and under the set filters, under the underlying assets, you could type in symbol or add it, and then instead of starts with or contains or ends or matches something that is very particular, let's for instance say UPS, and then what I might see is only the results for UPS. You might be familiar with a stock, or you know that your stock is in a range bound, and you could say, hey, does my stock hit this screener? So I can do that. The other thing that we can do to our filter to help us narrow down some candidates is we talked about days to expiration. Notice that our default here is 60 days or less. We said that inside of 30 days, we do see greater theta, right? So we could change that to 30. Notice I do have monthlies checked here. That is our default. We have had discussions before about the difference between monthlies and weeklies, and I know a lot of credit spread traders do trade weeklies because of these shorter time frames, and I'm not saying that you shouldn't. I'm just saying that it's a different philosophy of a trader, and that the reason why we tend to look at monthly expiration options contract is because of greater liquidity, right? Market participants, greater volume, greater open interest, and these greater liquidities will give us tighter bid ask, which will help when we go to exit these trades. These weeklies, sometimes you can see very large bids and asks, and that could take away from some of your profits. Okay. The other thing that we kind of touched upon was that philosophy of in the money, at the money, and out of the money. And so here you can see under our moneyness for our first leg, we have a range which is slightly minus 5%, slightly out of the money, to 5% slightly in the money. So what we said was we're going to look at a more conservative view where we're going to look at just at the money, right close to current price, to slightly out of the money. So we could change that to 0. That would represent closer to current price, and make those 2 small minor changes. And again, now I'll check my results. 2,000, and it's probably going to give me somewhere around 300 to 500. Let's see what it shows up. Oh, it's only 1,930. So there's a lot more trades out there for us to look at. The other thing we could do, again, we could do it in alphabetical order and look for those symbols that we like. Now, what I have done is I've created a screener with some inputs that might help you narrow the field down. Now, notice I put the screener in, and I'm going to show you what the elements are. But let's talk about some of the things that are in our screener that we want to look at and what is their importance. Well, first of all, our max profit. Our max profit is going to be that difference between the credit that we took in versus the debit that we put out. Our max profit percentage, right? Again, this is a value that is, now I gotta remember how to do this, is the max profit divided by the max loss. Okay, so that's how you get that that percentage. Our break even, right? Remember, our break even is the credit that we take in plus our lower strike. So for instance, here you can see our lower strike, our strike 1 is $75, and my maximum profit here is $1.61. So my break even would be 76.61. So ideally, when we start to construct this trade, and we're going to go look at charts in a few minutes, is we want to set our break even at or around an area of recent, in these scenarios, these bear credit spreads, right around a most recent high or an area where we perceive of resistance, right? And we're going to look at maybe a little bit lower time frame, so maybe inside a month. But when I set up my legs, my 2 legs, this differential between, let's say, $3, $5, $10, how wide do I want to set that leg? Well, I want to set that second leg at an area, at a much higher time frame area of resistance, maybe a weekly high or a monthly high, or maybe a 52-week high. So that would tell me if price got above there, that would probably tell me that I'm wrong in that scenario. So we want to kind of set our break even at structure or resistance that is current to our price action, and set that second leg at a more significant high or low. All right. Under my filter views, this is my strategies that I kind of look at. So some of the things that I have, well, the first 2 inputs I have is called the leg 1 IV, or implied volatility, and the 20-day historical volatility. So what I want to do is, in credit spreads, is we want to look to sell what we call a high volatility environment, right? The higher the volatility, the more the premiums are. The more premiums are, the more we can collect. So we want to look for a high volatility environment. So I picked very high as my default, but I could change that to high. Historically, right, I don't need to put a value here. I'm just going to use this as a comparative. What I want to try to find is that my first leg's volatility is greater than my 20-day volatility, right? It's telling me that leg, that price, that option is what we could say bloated, or there's a lot of juice in it. That's what we want, right? So that's what we're going to do. We're going to look at that as a comparative, okay? So let's go back to our screener. And so you can see here for ADM, our first leg is 46.9 and our historical is 31. That's telling us that all the calls that we're going to be looking at are going to have a little bit inflated value. Net delta. Now, any of you have come to a lot of my options segments, you know that I believe in this this golden net delta of like 25 to 35. That's kind of like the sweet spot. I just find that those trades tend to work a little bit better. And so I've picked a range of between 20 and 40. Now, this net delta we could go wider if we want, but to get a greater net delta, I'd have to pick a second strike. That second strike that could be a lot farther away. I could increase that strike differential. But if I did that, a lot of times what we want to do is we want to just look and see what that is giving us. If I have a strike differential, let's say of $5, and I say, oh, let's try to get a higher net delta, and I look at a strike differential of $10, well, is that extra $5 of risk that I'm going to take on that strike differential worth the credit that I'm going to take in? Now, let's just look at this, eyeball this here for a second. Notice that we have 3 trades right here. We have increasing net deltas. For our first leg is all the same, 92.50, and here we have 99, 100, 101, right? So, you know, we're increasing by $1. But how much am I gaining in my credit? So for every dollar of risk that I'm taking on, my maximum risk, I'm only picking up an extra 10 cents. You know, that's not something that I would feel comfortable with. The golden rule that we want to try to do here is, as we start assessing these credit trades, is we're going to look at the net credit as it relates to our strike differential, and we want to try to achieve a 1-to-3 ratio. In other words, I want to capture about a third of that strike differential. So for instance, if I have a $6 strike differential, I want to try to get close to $2, right? So again, you know, we're 9 days out from monthlies here. You know, this is going to be hard to find those 3-to-1s today. But when you look to set these trades, let's say 20 days out or 30 days out, you will be able to find those greater opportunities. Just remember that 3-to-1 is not the hard line. If you can get, let's say, 90% of 3-to-1, right, or 1-to-3, that would be a good trade. What I'm trying to keep you from doing is taking, you know, a little bit of getting a little bit of credit for a lot of risk. And I kind of call this the picking up nickels and quarters in front of a steamroller. You know, I know that a lot of the traders do this, right? And they do this on a weekly basis. They pick up a lot of little quarters every once in a while, every little bit every week. But then you get that one trade where you have a $10 differential or a $20 differential where something crazy happens, and one bad trade wipes out, you know, a month's or a year's worth of nickel collecting. So that will keep you away from doing that process. Okay, days to expiration, again, our volume, our open interest, right, and our strike differential. Okay, all right, and then I can go back to my main view and pull up, you know, the last price, my maximum profit, that percentage price, and look at those break evens as well. Okay, so at this point, what I like to do is I want to go back to my filter and see if we can find any good candidates, and then go to the charts. But as I'm doing that, I'm kind of sliding down here. All right, so for instance, right here, we have BABA. We have $3 on a $10 differential, and our strike differential here is 265 to 275. So we'll look at BABA. The other one I saw this morning was UPS, which has now popped out of my screen. Of course, that's live trading, right? And that's probably because it probably popped above that first strike. Let's see if there's another one down there. I saw pins this morning was close. Nope. Let's see what else we have. Well, maybe we'll just go right to Bubba. Neo looks interesting. Maybe there's one in here. Okay, so here we have Neo, where we have a $5 strike differential, where we're taking in $1.57. That's pretty close to 1 to 3, and my strike differential here is 45 through 50. So Bubba was 225 to 235, and Neil was 45 to 50. So I'm going to go to my chart, and first I'll go to Alibaba, and did I pick the wrong one? I apologize. Let me just, did I say 65? Or, yes, excuse me, 65, 75. Yep. Okay. All right. All right, so here we are. Current price is 264.43, 65 would be right around there. And then we said, somewhere above 275 would be that second leg. So I'm going to go to a monthly chart so I can kind of look at that. And you can see here, this 265 is kind of an area of resistance where price is now, we're in this kind of this sideways action, and we are kind of making, a downward trend. So this is an area where we should find some resistance, and that 275 is way back up here, and price would have to get above 271.50, 271 and a quarter for us to get nervous about getting to our 275 strike. So this one would fit those price scenarios that we want to look for, where our break even and our second legs. Now, what would be our break even? Well, we're at 265, and I believe we said we're going to take in close to $3, right, on this one? Yeah, what did we say here? Yeah, $3. So 265 plus 3 would be a break even of 268. Again, if I go back to my chart, well, let's just do this so I don't have to keep going back and forth. And I'll go to that monthly chart. And we said 268. Yeah, look, this looks nice, right? 268 is these two most recent tops over the last week or so. And that 275 is way up here. So that's kind of what we want to look for. We want to look to get our break even above a recent high, where we still believe that our market is in a sideways or downward trend, right? So the other one we said we could look at was, help me out, which one did I say? Let me go back to my chart. Oops, I'm way over on my other screen. Was it Facebook? No, it was 45.55. I apologize. Oh yeah, the Neo, right? Okay, so let's go to that one. And IO, we said 45.50 was the range of our strike differential. Again, I'm going to go to a monthly. And again, we see that 45 here is kind of in this downtrend, and 50 would be up here. And we do have two highs here at around 48.50, 48.25. So let's look at our break even and see if our break even is close to that. And so if I take in what I'm going to take in $1.50 on a, excuse me, I'm going to go to Neo down here. I'm going to take in $1.50 on a $45 strike. Well, that doesn't get me to at 85, at 48, but certainly it does kind of fit into our scenario. Now, the other thing you can do is, the screener does provide you these values based on the profits and the percentage profits. But let's say you wanted to customize your, you've gone to the chart, you've looked at where you believe that a good break-even value would be, or where you found a more significant high or low. One of the things you can do is you can go into the chart itself, excuse me, the stock itself, And so I put up DO, and down here we do see it says options, and you do see credit and debit spreads. And if I want to customize, right, I want to customize my credit spread here, then I can pick those different strikes. Now, they do these in ascending or descending order, right? So we were around $45. So you can see that there is a lot of strikes that we need to go. So you do need to use a little bit of diligence on this one, take a little time. But one of the things you can do is you can flip the strike prices around. Notice it's picking 65 up, right? And if I flip it around, I'll probably pick a little bit lower. Now, these are much lower, so we got to find somewhere in between. So probably not a great example to time-wise, but you know, we're getting close. All right, here we go. So let's say I wanted to customize. I didn't want to do 45.50. I could do, you know, I could do 46. You know, I could do 46.50 or 47.50, right? I could change that. I could change that, customize that scenario. All right, so I see some questions popping up. You know, and maybe some of these questions will get us into a little bit deeper detail as we go through. So let me. Any questions that pop out, Jean, that you see that a lot of people are asking?
Why don't you take a moment to review the ones that I've passed over to you? One of the questions that came up, someone's asking if this applies to ETFs as well. And on the screener itself, there is an option for you to screen just on stocks, which is what John is doing in this demonstration, or to check off whether you want this to screen on ETFs or even on indices. This is available both for the US equities market and for Canadian equities. All you have to do is switch your market flag in the upper right corner of the site, and you'll be screening on Canadian. And then the other question a lot of people keep on asking, is this session going to be recorded? Yes, you were going to automatically get an email later on in the session or later on in the day with a recording link for today's session. And you can always find these on our webinars archive page that John showed you in the beginning. So back to you, John. I don't know if you've had a time to look at some of the questions.
I've looked at a couple of them, and I think I've answered a lot of these already. So Aaron asks, you know, is the better manage early assignment? Isn't it better just to close out the position prior to expiration? And I think I answered that, Aaron. Yeah, I think that would be a wise decision, especially if that price is going above, you know, looking like our trend has changed on us. But again, Aaron, if you get a Steve Miller scenario where price moves dramatically in your favor in a very short period of time, again, you know, that might be an opportunity to take that trade off. And then again, I would use, like, you know, 3/4, 80%, 90% of the maximum value. All right. The other question was that Jean just says, can we use it for other asset classes? For example, ETFs and indexes? Yes, for sure. But we also can, those of you who are a little bit more sophisticated, you can do this scenario using futures markets as well. All right. Michael asks, I see that the focus of this webinar is stock options, which is fine. And he does ask that question, can we use it for commodity options? And yes, Michael, yes, you can definitely do it. It's the same concept, right? We want to make sure that we're collecting enough premium to justify the risk, and that we're going to use our chart analysis to help us design the trade based on the strike differentials and those break evens. Okay. So I see a question here that says, what if I can't exit, i.e. no bid? Right. So that scenario would mean that, let's say, you're talking about your long, right? And that's your, you're getting very close to expiration, and there's no way to get any of that money back that you bought. That's a reality, right? Because that option has no value. But if you are short a call and price has moved up higher, I guarantee you're going to find an ask to get out. In other words, somebody is going to give you an out, right? So really the bid scenario would be that second leg to try to get a little bit of money back from the money that I put out. So that was for Jurgen, okay? So Philip asks, the trades coming up on your scanner right now are bearish stocks. Not necessarily, Philip, not necessarily. That's why we need to do our due diligence of not only selecting our strikes and our profit potential, but why we come back into our flip charts, why we do our chart analysis, right? We want to look for bearish stocks. We want to look for markets that have that bearish potential. Now, let me ask Philip. Philip, would you feel comfortable shorting this stock? Maybe not, right? Because this stock certainly looks like it's in an uptrend. Yeah, maybe we could look at see if this high was a significant high, right? It probably is a 52-week high, but this market is certainly in an uptrend. I feel a little bit nervous about looking to take a short scenario, right, or bearish scenario, right? So this one actually fits our criteria a little bit better, right, Philip? What is this stock doing? It's in a range, right? It's in range. Now, it just has recently come from the higher end of the range, which would have been the ideal spot to put that credit spread on, but this would be a better candidate for this strategy. Chewy, let's see here. Okay, so, again, this one where market is still in an uptrend, but, we have made a significant correction here. So there could be an opportunity in this one. Again, let's look at our NEO, which was one of the ones that did fall into that scenario that came in our screener. And boy, this one really kind of sets it home, doesn't it? This one does look like it's more in a downtrend than an up or sideways trend. And again, we do have some very recent highs that we can start doing those assessments again. All right. So I hope that answers Philip's question. So SD asks, is there a risk versus reward calculation you like to use? So SD, again, what I kind of look for is I want to try to capture about a third of the strike differential in my credit. Now, it's about probability, right? If you think about the probability of a trade, there's three outcomes. Price can go up, price can go down, and price can go sideways. And so what we're trying to do is predict two of the three. We wanted to go sideways to go down. But unfortunately, nobody is going to give us those odds, right? Anyone who's going to take the other side of our trade is going to want better odds, right? That 3-to-1, right? So that's why we look for that ratio, okay? So again, if I can get close to 3-to-1, 90%, then that would fulfill that criteria for me as far as risk reward. If you, SD, if you are using in the money first leg strikes, you will see a lot greater potential for profit. In other words, you will see, maybe 2-to-1, but you are taking on that assignment risk, which is something that you need to be aware of. So you better make sure that if you do those ones, you make sure that you definitely have a stock that you believe that's in a downtrend or an asset is a downtrend. Okay, Armando asks how to manage a call spread when the underlying is getting close to the long leg. So again, Armando, I think at this point, if you get above your break even, right, well before you get to that second leg, at that point, I think you need to think about managing your trade. Now, either exiting the whole trade as is, but there are ways you can what we call roll up, and I'm not going to go down that road right now. But I think the more important issue would be is when your price gets above your break even, that's really the market's telling you that you're wrong. So that would be the point where I would be managing my risk. All right. Okay, so I'm just kind of going through a lot of these questions. How do Adelphius, I apologize if I brutalize your name, just asks, how do you select a sideways moving stock using your screener? Well, again, I'm not going to use the screener to define a sideways market. I'm going to use my charts, right? And I think it was this one, right? Let me just, yeah. So what defines a sideways market, right? Market is making equal highs and equal lows, right? So I'm not going to use the screener to look for a sideways market. I'm going to look at the range of price, right? The range of price. In this case, this market since the middle of November has been stuck between 135 and 145. Let's just go through the money on this one. Let's look at the numbers. So the high end here is 145. So what I would like to do is see if I can find, you know, a strike combination where I'm setting my second leg above 145, or my break even is getting close to the upper end of this range. So Beyond Meat, and what do we have? All right. So we have 145, 155, right? That's kind of what we're talking about. And I'm picking up $2 on an $8, a $10 differential. Probably not what I want, right? I probably want to lower that. Now, what I could do is, you know, maybe lower this strike leg, going back to my chart. Look at a significant high or low in the last couple of weeks. And again, you know, I really don't see that opportunity, but let's pretend this 145 was actually 140, right? Then I could rechange or customize that scenario. Daniel Hall asks, is rolling cover in the educational elsewhere? No, we don't have that in there, but I would, you know, there are resources that you can use. For instance, is the Option Institute Council, or I would go to the CBOE, the Chicago Board of Options Exchange, and they do offer educational services and to get in these more complex strategies. I also would recommend, for those of you who are interested in a book to read, and there's one out there, it's called Strategic Investment by Lawrence McMillan, which is really good, and that one goes into depths about rolling ups and rolling downs. All right, so how are we doing on time, Gene, here?
We've got about 10 minutes left or so.
Okay. Let's see if we can answer a couple more questions. James Koch just asked, is delta a significant factor in determining the strike price? Yeah, James, I think what we kind of talk about, this delta, this golden delta we want to look for is around 25 to 30. You know, what delta does, when we look at delta versus our strike differential, it kind of bakes in the vega. That's you know, we're not going to go into Greeks in here, so that's one way to do it. Another way we could do, if we didn't want to look at delta, is we could look at what we call the IV ranking or IV percentage. That would be something that we could do. So again, under my view here, James, what I kind of look for, and I use this for both my call and my credits and debit ones is I kind of look for that net delta between 20 and 40. Just for my personal experience, that these are the trades that work. They just, some reason they work. I don't know why. I'm not a rocket scientist when it comes to the math and the probability. I just find that these ones tend to work a little bit better for me. Again, if I wanted to look for a higher delta differential, I'm just going to set a higher second strike. Doesn't mean that I'm going to get that value to set that higher strike, because it's going to take on more risk. And I think we kind of bared this one out before. Let me go back to, let's see if I can give a good example here. So for instance, here we have a $35 strike, $35 strike versus $42.45. So we have a $7 differential, a $10 differential. How much did my delta improve, right? How much more credit did I get by taking on, was it $3 more worth of risk? I got an extra, what, 40 cents. That one would probably be a little bit better for me. If I'm only getting 10 cents for every, dollar, maybe, I don't know. I would probably want to look for that 3-to-1 ratio. So I'm taking on, in this case, looks like $3 more worth of risk. I want to probably get close to maybe 70 cents more credit. So that's the way you can use that. All right. Okay.
So John, I'm going to jump in here and take a couple of these questions. If you want to go back to the filters tab, you can drive the website while I do the talking for a moment. There's a number of people that are asking if there are filters for implied volatility, delta, Barchart, opinion. And one thing that if you can show, if up at where it says add a filter, yes, right there. If you are looking for something specific, and there are so many filters in these screeners. So for instance, if I'm looking for implied volatility, just start typing what you're looking for and we will show you the filters that are available. Let's look for opinion. Someone was asking, can I look for, okay, so that's the overall opinion percent. Go ahead and click on that. And you'll notice right underneath it says underlying asset overall opinion. Okay, there's right above there, there's the overall buy, sell, hold signal. John, hold on. Whoop. Okay, let's search for signal.
Okay. I apologize. I'm trying to anticipate where you're going at.
Yeah, the overall buy. There's a number of things here. So I can filter if I'm looking for stocks that have an overall buy signal, and that means it's taking all those 13 technical indicators and all 13 of them are agreeing that this is in a buy trend. Or you can actually choose stocks that appear on popular bar chart pages like the signal upgrades or signal downgrades. So yes, this is a very complex option screener, and our suggestion is really you need to come in here and look around and see all of these different things that you can screen using, the different filters that can help you narrow down your trading candidates.
So great point, Gene. One of the ones that I like to do as a screener is I throw it in every once in a while just to look to see what's going on. So we're talking about a credit spread where we're looking for inflated volatilities, where we're looking for inflated premiums. So a lot of times I will go to the most active stock pages or the most active options page to screen on those lists as an opportunity to look for those ones as well. So yeah, there's a lot of ways that we can narrow down our candidates. You might have your own watch lists that you have created, and I have several watch lists that I've created that are either found on the options or the underlying. So yeah, so I think it's really important for folks to understand is that a lot of the information that I've given you today is really kind of just a guideline or guidance for you to help you narrow down our candidates. But if there is something that is very particular to you, for instance, your moneyness or your net delta, here's your max profit, your strike differentials, your credits, under the underlying asset, right? You could look at, not only technical analysis, but you can also start to look at some fundamentals or earnings dates or what sectors they're in. So there's a lot of material that can help you narrow down our candidates. All right. Let me just double and check our questions. So I do see a question that just popped in. The question says, so assignment only possible after closing of the day, not during the opening hours in case of expiration yet not reached. So yes, you will receive an assignment notice. You could receive that assignment notice on the opening of the day, but the way options work is that you won't be assigned until the end of the day. So somebody could have choose to elect to buy or to exercise a call after the close from the previous day, and you would receive that assignment beforehand. But as long as you close out your position before the end of the day, when you get the notification of potential assignment, then you will be all right. So on expiration day, unfortunately, though, if you hang on until the end and you don't have an assignment, you won't know that assignment until after the market closes, until the market settles, right? Because those people that are going to exercise those options, a lot of times the brokers will actually exercise on the behalf of their clients if that leg is in the money. So you don't always know that you're going to get that assignment. Okay, so it's pretty close to an hour, right? I think we're right at an hour, aren't we?
Yes, we are.
Okay, great. Well, listen, I hope you enjoyed today's segment. Thanks, Gene, for helping clarify some of those questions. And, I do want to remind everybody that we do offer a free trial to our premium membership, and that a lot of the screener stuff that you're going to find on other areas of our webpage are part of our premium package, and that you do have an opportunity for a 30-day free trial. So I would encourage those of you who are interested in this to give it a shot and see what you think, and I think you'll find it more than advantageous to your trading. The other thing that I know Gene is going to want me to talk to you guys about is that next week our subject is going to be how to build a successful trading plan. Now, let's be very frank here. I know that this concept of trading plan is not a very exciting or glamorous concept. It's not really about, making money, or so to speak, but I think it is very, very important for all traders to have a trade plan, and that without a trade plan, you are planning for failure, according to our friend Benjamin Franklin. So this one, this one is a little bit outside the box. It's less about what elements we're going to find inside of Barchart, but it's more about just give you some food for thought to help you put together a trade plan and some things that will help you put you on that path to success. All right.
Start 2021 off on the right foot.
Yeah, exactly. I agree with you 100%. All right. Anything else, Gene?
No, that's it. Just wishing everybody out there a very good day, very good week, and we'll see you next week, I hope.
Yep. Safe travels. Everybody stay healthy, and good of all trading.